Hello everyone. We have just completed the April, May, June quarter of the Indian economy and the results are out. It's time for us to take stock of what happened in the last quarter. What is the observations we make when it comes to question of what the markets perform, the risks which are building here, the opportunities that are visible. It's a quarterly update, and we have Harini, the fund manager at Tamohara Investment Manager, is going to take you through every bit of information you need to be knowing to make that wise decision. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Are you an NRI living outside of India for more than 10 years? Have you dreamt of a retired life in India in a beautiful house and a lifestyle of your choice? Your dream can come true only when you take some simple and effective actions today. I will take you through a step by step process to make this dream come true in my webinar Stress Free Retired Life in India. Hello, I am Dr. Chandrakant Bhatt, financial guide and founder of YouTube channel NRI Money Clinic. I have to my credit creating secured retired life for thousands of NRIs spread across more than 60 countries. If you have an intention to make your dream retirement come true, register for my webinar. More details are in the link below. So, dear viewers, to take you through the scorecard of the Indian stock market in the last quarter, we have with us today our guest speaker, fund manager Harini Dedhia. She has been a very popular speaker on the channel. She is a fund manager at Tamohara Wealth Manager. She is also the head of research at Tamohara. She is a fund manager with enormous experience. She started her career in a hedge fund in New York and later on worked at multiple places and currently looking after investments at Tamohara Wealth Managers. It's over to you, Harini, to take you through what's your observations in the Indian economy during the last quarter. Over to you.
Thank you, Dr. Bhatt, for having me. Things are moving so quickly. I remember last video which we did around March, April. We spoke about, us wanting to buy and, things looking incrementally good from here on for the equity markets. In terms of earnings downgrade bottoming out or, earnings not being as bad as people think they're going to be. And, from there on, portfolios in India are up anywhere between 10 to 15% on an average. So it's quite stunning almost, to say the least, as to the speed with which, things are getting discounted and working. 10 to 15%, you would expect that kind of a move to happen in 9 to 12 months, especially given the last 5 years, right? With that context, but things just are moving very, very quickly. So it's a great time for us to also, pause, reflect, and see, take stock of what's happening around the world, and especially for Indian equities. So with that, I will dive straight into the update. I will keep the format the same. So when we look at the macros, like I said, markets pretty much have bounced back across the world. In fact, I would say that in the last 3 months, India would be in the, third or the fourth quartile of equity markets globally. In fact, rest of the world has bounced back much faster than and much better than India. And then there are some markets like South Korea or Europe that are making fresh highs after a long, long time. So we are in a phase where equities around the world have done well. Our US 10-year, which is sort of an indication of, how serious of a mess is the global economy. And we've seen that, which had gotten aggravated a little bit, come off. We've seen dollar take a massive hit. Versus the Indian rupee, it is still not as visible. You still feel that, the rate is similar, 85, about 6 months back, 85 today. It, of course, went up to 87, 88, but dollar index on the whole has seen a correction of about 10%. So that has been quite a significant move. And that is actually helping all the emerging markets attract flows back into them, because now your dollar denominated returns are naturally getting boosted up a little bit. What has been surprising is really crude oil, right? With all that is going on in the Middle East, you would have really expected crude oil to be flaring up, and it did. It momentarily did, but things have calm down again. Of course, this data that we're showing is as of March end because we do the review after all the results of the March end quarter come in, but pretty much around similar levels till date. And gold has continued its rally. So we're in an interesting phase where, perhaps people are looking again at gold incrementally as the reserve currency of the world. Dollar is definitely losing some of its sheen. Rather, it has lost some of its sheen given the tariff tantrum, so to speak. But with all of this sort of background and with now Nifty about 2000 points up from where it was, when we take a look, first of all, it is important to understand why was this recovery there. While we had called it out in the last call, a couple of things that even we didn't think would happen so quickly. One is markets expectations on tariffs changed dramatically, right? So remember 3 months ago when we had seen a call for a temporary pause in tariffs. Now that has sort of led to an expectation of tariff truce definitely ensuing. It's also because a lot of the countries that probably the US regime expected that would bow down or cover to make a deal with them, that has not happened. People have really taken a stance of, okay, we'll discuss at our own terms, at our own time, kind of a thing. So that has possibly led the market to sort of expect that, okay, this whole tariff narrative, is no longer going to be championed as much as it was 3 months back. We are seeing weakening of the dollar, which is leading to improving FII flows, and we will show some of the data of why that's important later on. Domestic macros are improving, and GDP growth has bottomed out, and valuations are fair. We're not arguing that valuations are cheap, but there are definitely pockets where valuations are fair and investable. So when we talk about the tariff truce, the 3 months window for tariff negotiation, which sort of expires later this week, we are seeing countries that have not given into, the pressure by the American regime to come on the discussion table and negotiate a deal. And that is possibly making the regime in the US take a stance back and say, okay, we probably need to do a little more give and take. But the general expectation is that there will be truce around the current new normal, which is what was announced 3 months back. India has gone ahead and signed a free trade agreement with United Kingdom. So hooray for all those Scotch drinkers in India, I guess. And US and China trade talks seem to have given a fair idea of what the likely outcome is. And all of this put together has just led the markets to believe that, hey, it's business as usual. Let's get back to work. We're not required to really check our Twitter accounts every morning we come into work to figure out what's happening with the tariff war. The second thing that's happening on a global side is, of course, the massive crackdown we've seen in dollar. Now, 10% for equity markets or a stock price is, nothing, but for US dollars, 10% is a massive move. So having said that, we're seeing foreign investors looking incrementally more at emerging markets because, again, dollar denominated returns look better now in these emerging markets. And what happens when FII flow comes back is you definitely see a period of sustained market performance, right? So let's look at the periods when the FIIs have sort of taken money out. So 2008, of course, that's it's the global financial crisis, so it's a different story. But let's look at 2011. We've seen, $1 billion net of selling, and we've seen negative returns on the market. 2018, we've seen $7 billion negative sell. We're seeing negative returns on the market. 2022, so this is, post-COVID, stupendous run-up. And 2022, we've seen a significant outflow, and markets were pretty much flat. In fact, small caps bore the brunt a lot more, but otherwise markets were, pretty much flat. So what has happened is, even amidst the bull run that we've seen for the last 5 years, the year when FIIs decide to take money out is the year that you see flattish or negative returns. What this essentially tells you is that you definitely need foreign investors to commit capital to see a run up. What the domestic investors or this whole SIP flow can do is help cushion the downfall. So you won't, every dip is getting bought into for sure. That's not something we are contending with. But between the domestic investors, for them, there is no alternative, right? So they're just constantly, buying whatever supply is out there. But FIs, they're buying with a clear intention of making an allocation to India and believing that there is growth in their capital that's going to come in from here on. And the clear example of that is, 2023 to October 24, we've seen net inflow of about $32 billion, and we've saw one of the most amazing market performances in India in the recent times. Now, when we really look at the data beyond that, like when we start dicing it into, each and every quarter, you'll see second half of last financial year, so October to March onwards, we've seen FII selling and we've seen markets giving negative performance in both quarters, minus 8% in quarter 3 of financial year 25 and then minus 5 in quarter 4. So, and then now that the data has turned incrementally positive April onwards, we've seen markets perform very well and give a 10% return, which we sort of spoke about earlier. So, it's very clear that while the domestic flows picking up over the last few years has ensured that incremental FII selling will get bought into, therefore, we won't have sharp corrections as we used to just because of FII selling, but we will definitely see up moves, when there is committed FII buying that comes back into the market. Now, looking at domestic macros, we are seeing, liquidity improve across the board. This is something that we've spoke about in the last call as well. In fact, November onwards, we had started seeing that movement up in M2, which is the money supply metric that we follow. The RBI governor has announced the 50 bips repo rate cut, 100 bips CRR cut, and both of these steps will ensure that liquidity is increased in the market. And in the first quarter itself of the tenure of the new RBI governor, we've seen a very accommodative stance, so to speak, by the governor. When we further dive into how that translates into corporate balance sheets, the NPA cycle is pretty much at a low. Corporate debt to GDP cycle is at a low. So now with the banking system having positive liquidity, surplus liquidity, and NPAs being low, I think we're going to see a lot more propensity to lend. In fact, the first data point that we're seeing emerging for this is, for the first time in a decade, corporate debt issuance is overtaking corporate debt repayment, right? So we are now seeing, corporates coming back to the banks and to the bond markets and, leveraging up. Their balance sheets have more than enough space for it. And the banking system definitely has enough surplus to do so. I think most people wait for this GDP number. Now, looking at a GDP number and sort of commenting on future is sort of, doing rear view driving. That's not how you're supposed to really function. But what also happens is, when psychologically speaking, capital allocator, and I'm not saying a financial capital allocator, I'm saying people who invest real, money into real businesses. So, but we also invest real money. But what I meant is, who create actually physical capital. When they start seeing GDP print that is as strong as 7.4%, which is what it was in Q4, we do see boardroom discussions sort of starting to move a little bit more towards action, at least on those businesses where they are completely reliant on domestic consumption, right? Of course, where they're still facing export markets, they probably want to wait till later this week and see what comes out of the tariff agreements. A few people have already started making the judgment that, there is a truce and this is what it is. But it definitely, when you see 7.4% GDP print, it puts you in a mind space of wanting to invest in that new capacity, take that call, some decision that was probably languishing around and you were saying that, hey, market conditions aren't good, scenario is not good, not really sure. When you see such robust numbers, you feel like, okay, let's start putting money on the ground again. We are seeing for the first time in this current investment cycle, private capex overtaking government capex. Now, this is a very important point, right? Because government capex is almost done without an expectation of an IRR, right? It is done because it has to be done, kind of a thing. Private capex is done when there is an expectation that I will meet my IRR requirements. So now you're seeing two data points for the first time in this investment cycle. We're seeing debt issuance, corporate debt issuance overtake debt repayment, and we're seeing private capex overtake government capex. I think both of these sort of bode very well for how the boardrooms and CXOs are viewing growth in India. What we've seen historically is that bull run mirrors profit growth. And currently, the corporate profit to GDP ratio is about 4.7. In the last sort of investment cycle, this peaked at about 5.2. But in this cycle, I feel like it should probably hit about 6%. The reason for that is very simple. By the time we reach 4.6, which is in 2007 in the previous cycle, we were already operating with severely leveraged balance sheets, right? And that sort of hinders your ability to grow profits beyond a point, right? Because then your depreciation and your interest costs start hitting your PAT level profitability. Today, with a completely delevered balance sheet, we are at 4.7. So there is still time and space on the balance sheet for us to see incremental growth come in before the balance sheet structure starts eating away from your profitability. So I think we would likely see corporate profits do better, and I think people have also become a little more prudent about balance sheet structuring. There is more capital available to investors today. Tax rates are definitely lower in India today. So if you put up a new manufacturing unit under a new entity, it's at 15% for the rest of the life of that unit. So all of this combined, we think that this time around we'll definitely take out that 5.2% corporate profit to GDP ratio. And if that is the case, of course, market prices are slave to earnings in the long run. So we will see that sort of move along as well. Just, want to throw caution to the wind over here in terms of expectations, right? Last 5 years, we've seen a stupendous run up. That run up has come after a decade of very subdued returns at an index level, right? So when we see, oh, Nifty IT has done 25% plus compounding in the last 5 years, what you've got to remember is in the last 15 years, that compounding is 18%. So for the first 10 years, it did only a 10% CAGR and then followed it up by 26%. So on the whole, if you see, the reality of markets is it trends around nominal GDP growth, 12-13%. So whatever we saw in 20 to 25 is essentially a catch up that was being played for this lost decade of market returns at an index level. So we really can't expect, that to, continue. So last 5 years cannot be sort of extrapolated. But last 15 years is a template that one can work with, right? Last 15 years will show you normalized returns for sectors. And that's a template that essentially shows you the mean outcome for these sectors. So that is just, to throw caution to the wind. So when we say what we discussed on this previous slide about corporate profits having headroom to grow and markets being slave to that, we're not expecting we're in fact going to expect derating in valuations in a lot of cases. We expect that some of this earnings is already baked into price, but think that the last 15 years provides a good enough template for us to figure out where returns could be in various sectors. So while we've addressed market kya lagta hai, to just summarize our thoughts, I think most importantly, earnings downgrade cycle is over. What we mean by this is, analyst consensus estimates for earnings of Nifty 50 companies or BSE 500 companies. Whatever estimates and numbers had to be cut, that's already been done. And from here on, you will see companies either on the whole or on an aggregate level meeting or beating this number. So you will see some sort of upgrades possibly come up at some point as well. If you've been following us on this channel, you know that my view on this has probably changed after 7 or 8 quarters now. I think 7 quarters straight we were expecting downgrades, and I think now we think that that's sort of behind us. It is true that small and mid caps are more expensive than their historical levels. There is no debating that. We are not saying that anything is cheap. What we are saying is that while their valuations are above their long-term averages, so is their growth outlook, right? So we're expecting earnings growth of 17.5 in mid-cap space, 22% in the small cap space versus 12-13% in the large Nifty 50 space. So if markets are slave to earnings growth, higher the earnings growth, higher your valuation. That's how it's going to play out. So we believe that there is some merit in small and mid caps trading above their long-term valuations. So how would we position ourselves in this sort of scenario? What we said last time is private banking will continue to do well. We spoke about capital goods, alluding to being very, very favorable for both those things. And we also spoke about agri, good kharif season, easing credit norms, inventory in agrochemicals rationalizing. We still hold all of these views, and we are adding a little more sort of data points to it, right? So on capital goods, I think two important data points. If there is anything you do take away from this video, I would wish for it to be these two data points. One would be that private sector capex has overtaken government capex for the first time in this investment cycle. Number two, debt issuance has overtaken debt repayment by corporates in this cycle. Right. And I think this is the third time I'm saying this sentence in this sort of webinar. So, I'm trying to reiterate this fact. So, because of this, we do remain constructive on capital goods. And because of this, we also do remain constructive on private lenders, right? Because any bank that has a clean, good balance sheet, that has room to start lending now, that has done extremely well on their deposit franchise so far, I think we will start seeing acceleration of credit growth and therefore acceleration of earnings for these banks. Additionally, what has happened is earlier this year in the budget, our finance minister sort of has given an incremental benefit of up to 60,000 rupees for all citizens and up to 1 lakh for, special categories of citizens. But we're seeing a tax benefit being rolled out by the way of tax rebate. So earning an income up to 12 lakh rupees from normal income sources. So capital gains, additional income sources are kept out of this, but your basic salary or consulting income, all of that comes into this. So earning your basic income up to 12 lakh rupees in India is now going to be tax free. So this is a significant push. And we think that this is going to, of course, this increases discretionary money in hands of consumers. We are going to see the next pay commission come into effect in January. We are likely to see about a 15% hike over there. We are seeing RBI's focus on pumping liquidity. And stocks in the consumer space have done nothing for the last 3 to 4 years. So this is another area that we think that there could be some opportunities in. We do have a couple of consumption plays, but they're so far either an ancillary, so a packaging company, or into the luxury consumption space. What we're now referring to is sort of the aspirational consumption space, right? So the middle of the pyramid consumption space where you see a lot of white goods, you see a lot of people upgrading from one brand of apparel to another, things like that. So that's something that we're evaluating, and we think we're going to see a lot more traction in. So, on that note of a potential idea to look at, a potential sector to look at, I think that's where we would want to leave our current conversation at. And, really hoping that the robustness with which the monsoons have come in this season sustains, and, we all enjoy good rains with some great chai and vada pav, of course. That's it from our end. Thank you so much, Doc, for having us over. It's actually helping us a lot, by doing this exercise on a quarterly basis. Thank you so much.
So, dear viewers, hope this detailed explanation of the quarterly update helped you to understand the trends in the Indian stock market and make you a wise investor beyond this point. If it helped you to understand what you need to know, do give me a thumbs up. Our channel grows because of your subscription. Please hit that subscribe button and press the bell icon if you are not yet subscribed for the channel. It's a great help if you could share these videos with your friends and relatives, near and dear one, and on all the social media on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another expert, with yet another topic next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.